Hey everybody, welcome to the morning market briefing Tuesday, March 29th, 2022. Hope you are hanging in there out there. Just a couple days left in the quarter, and we're starting to see some real potential progress as it relates to the major story of the opening portion of this year, which is obviously Russia's invasion of Ukraine. Ben, Russian negotiators have arrived. The Ukrainian delegation arrived overnight. Ukraine's position is that they could accept a neutral status as part of the deal. There's lots of moving pieces here, but it seems like there's some actual meat on the bones of these discussions and theorized paths forward for the first time, really, since this conflict started over a month ago. What's your view on kind of where things are? I don't know if you want to put odds on this bad boy, but how do you see it playing out?
Yeah, I think the odds I can't really give you odds, but I would say the thing that's different this time in terms of these peace talks that are actually going forward is that there are some people talking about there may be conditions by which Putin and Zelensky can actually have a conversation, which I think would be a significant step forward. The other piece is, for once, Russia's actually indeed pulling back. They're definitely not attacking Kiev as much as they had been. And they're really focusing mostly on the south. But even then, it's pulled back somewhat. What they'd really like, I think if the Russians would really like, is they're pulling back right now into the Donbas region of Donetsk and Luhansk, which was those places that they recognized as independent. They're trying to create a land bridge around the south through Mariupol. I mean, that's becoming a critical city. And right now, I think that the Russians, at least in their negotiating stance, are saying, we want those independent republics, we want Crimea, and we want some sort of way to connect those two. And I think that's ultimately what they would like. The question is, will Ukraine actually give on some of that? I think that even with Crimea, Ukraine is a little bit anti the annexation on that piece, let alone Donetsk and Luhansk. So I think that there are some significant things that still need to be dealt with. Having said that, I do think it's significant that Russian forces are pulling back. What Western people say, whether it's the European Union or in the US, is that this is just almost a false front by Russia in terms of saying we're getting closer to a peace deal. Their view is that that's the Russian tactic in order to allow their troops to go back into Belarus and into the strongholds in Donetsk and Luhansk, recharge, refuel, get fed, have new supplies, and also switch out for some of these mercenary groups who have come in to help the Russians. So that's the other aspect to it. I do think it's good news that they seem to be less focused on Kiev. It seems that they understand that they don't really have much of an opportunity to go in there, at least not right now. And importantly, the Kremlin did say that the main tasks of the first phase are complete. Now, it would be great to know the phases of the whole Russian war plan, but it is interesting to note that. And then I do think that we're basically in this bifurcation. Is Russia pulling back because they have conceded that they're not going to be able to take Ukraine the way they wanted to, or are they pulling back just to recharge and then mount another offensive? Based on these talks, I mean, based on the words, you'd say the former. Based on Putin's prior actions, you might say the latter. So I think that's where it's really up in the air. The marketer is a great arbiter and judge of potentially what could come next. And right now, the market is quite strong. We're down less than 3% for the year, the S&P 500, according to futures right now. So I think you would have said 3 months ago, the Fed's going to raise extremely aggressively. We're going to see significant inflation, and Russia's going to invade Ukraine. I don't think you would have said that the S&P 500 would be down less than 3%, but that's where we are today.
Yeah, I want to camp out on that point for a second, Tom. Obviously, you're kind of the foremost expert here on covering the Fed and their actions. I mean, do you think in some ways the Russia-Ukraine conflict kind of gave them some cover because there was another major story that people were associating on equity markets. Do you think that like gave them a little bit of relief potentially?
Yeah, I think it definitely gave them an excuse, right? They could always say, hey, we're going to change up because, obviously the situation has changed, right? We're going to try and combat inflation, but now we've got an oil crisis because, one of the major oil producing countries is completely isolated. I think if this really is a true ceasefire, true peace, we're coming out of this thing. I think that the Fed is going to get more aggressive. And if you look at the futures market now on the Fed funds rate, we're looking at 9.5 hikes this year based just on this morning. And that's a significant step up from last week. There's a lot of talk about potentially seeing multiple double hikes in a row. And so the rate situation is tough because, to Ben's point, the equity markets are only going to be down about 3% for the year so far this year, but the bond market is down, we're getting close to 7% for the year. So it's one of those rare times where having bonds in your portfolio has actually been a net drag and may continue to be so. But it's important to remember in the long term, every time we have a bond come due, we can reinvest and make, at this point, more than double, what an equivalent bond would be trading in last week. And if you look around the world, zero interest rate and negative interest rate policy is quickly eroding. With the exception of some of the very short-term bonds in some of the big European countries like Germany, almost every nation now dealing with positive interest rates. The Japanese JGB 2-year went positive for the first time since 2014 yesterday. That's a long period of time where we've had very, very, very low or negative interest rates across the world. And I think if this thing really wraps up, we could definitely be jettisoning that worldview for the foreseeable future, at least until the next recession where they take rates back down. So it's going to be a bumpy road for bonds, but it's important to remember that losses on paper for bonds go away as soon as the bonds mature. A bond can go, all the way down to $1 per bond, but then if it reaches maturity, you're going to get $100 back. And so a little bit of that is just paper losses while we wait for income to roll in to replace the principal that's been eroded. But every new bond is going to be a nice fat juicy yield compared to some of the things we've seen over the last couple of years. Even going back to 2009, 2010, we're seeing some deals on bonds that are a little bit more in the tradition of what bonds were pre-financial crisis.
Yeah, I think it's a little bit nuanced. If you're a client out there listening, it's odd to kind of say we're not real worried about what the printed return is on fixed income for a given quarter or even for a year. We're mostly concerned with what the security of that particular investment looks like. How likely are we to get our money back, and when is that happening? So the good news is we feel like we're pretty strong there, and it's also one of those things where it kind of sounds weird to say, hey, the good news is you own bonds that are maturing and we can buy something new, but that's how it works. If we're gonna remain disciplined on those allocations, on equity, you might see little moves in a portfolio. You might see a stock come in, a new stock go, or an older stock go out. You might see changes in allocations. The stock was 4% of my portfolio, now it's 2.5% based on our convictions. But on the fixed income side, it's equally tactical. But you may not see the trading volume that you normally would see on the equity side of the portfolio, but it's almost proactively tactical, and that we're trying to have money constantly coming off the table. So if you have questions on how that's playing out in your portfolio, don't hesitate to reach out. We'll talk through it. Switching gears, we do have Biden's new budget proposal out. Anytime we're looking at budget proposal, there's really kind of two questions: how much more are we going to spend, and how are we going to pay for this? We're seeing domestic spending increase by 7%. We're seeing military spending go up a bit. Ben, what are some of the high points? And the big question probably on most people's minds, if they've seen the headlines already, is what's this billionaires tax thing and how's that work?
Yeah, I think on the spending side, the big takeaway is that President Biden has moved away from some of his more controversial issues that he had before. Now the domestic spending seems to be focused a little bit on the pet projects, but more manufacturing investments to address supply chain issues, inflation, military spending on missile defense. And he's also looking to raise taxes. So he's now looking at a billionaire's tax. rather than a millionaire's tax. And this would be on American households worth over $100 million, where they'd have a minimum 20% tax on their income, as well as unrealized gains of liquid assets, so stocks and bonds. I do think an unintended consequence of this is if you're taxed 20% on your investment portfolio, regardless of whether you sell, you might as well have that in an illiquid investment, which doesn't price. And so you'd think that billionaires might invest a little bit more in property, more in private equity, things that don't have embedded unrealized gains on it. So I think that could be one unintended consequence of that. You would also see a raising of the tax rate, the top tax rate, the one that's currently at 37%, that would jump to 39.6%. But probably the biggest one that I see would be the corporate tax rate that would jump from 21% to 28%. I do not think this would be very good in the present moment, given how companies are already digesting higher costs. I think that you could actually see corporate tax revenue weirdly fall if this happened, because you'd see less investment, you'd see more uncertainty, things like that. So I do think that there's a dynamic piece to this that isn't fully appreciated by the budget. Having said, this is a budget proposal. It needs to be, Congress needs to go along with it, and there will be many, many, many changes along the way. I ultimately do not expect that corporate tax rates will go up to 28% from 21%. At least not with the current Congress. I think that ultimately the big picture here is that President Biden is trying to pivot from the Build Back Better agenda into more nuanced, specific elements of that agenda. So he's talked about prescription drug prices in the past. I expect that to be a hallmark of the next 6 months. He's talked about raising taxes. We're already seeing that here. I wouldn't be surprised if he talks about rent gouging as well, given all the headlines and the 60 Minutes piece we saw last week about apartment rents going up a lot. So I wouldn't be surprised to see more rhetoric on that front, especially as potentially the Russia news fades to the background.
Awesome. Two more stories to go. One that was pretty late breaking relative to this call, but let's jump to Tesla next. Tesla has really rallied. It bottomed out on March 14th. It's up close to 45% since then. This is a major contributor to the S&P 500 in terms of performance, because Tesla is close to 2.5% of the S&P 500. It's going to contribute essentially 1% in terms of growth to the S&P when you think about the size of it and the amount of rally that it's had. Ben, we get asked this a lot. I was speaking with a young client recently, a daughter of a client that is kind of getting interested in investing, and Tesla's, as you might expect, on her short list of stocks that she'd like to be picking up. At a high level, why is Tesla something that, is not a core holding here at Narwhal?
Yeah, it's the fifth biggest company in the United States, and we don't own it. So why not? And I don't want to really talk necessarily about valuation, because I'm sure those comments, that's an easy straw man to come up with. But one reason that we look through three lenses. We look through the moat, the management, and the macro side. On the macro side, I actually think Tesla is somewhat well positioned, especially given higher gas prices recently. I think that Tesla is still the name in electric vehicles. I do have concerns about the moat. I think that in terms of the competitive pressures, I think that Tesla is in a market that they will try to say it's not crowded, but there are a lot of auto manufacturers out there. I do not think Tesla is sufficiently different. We've seen auto manufacturers come and go in almost a fashion sense. So I do have some concerns with that. You could argue that the margin has widened a little bit, but I do have concerns with the moat. And then I have concerns about the management. You have a management team that lacks board oversight. They have made pretty fast and loose moves with the balance sheet, which is, as a shareholder, you don't really have much control over that. And then you do have a little bit of concern around the valuation. They have started to generate a profit in the last 18 months, but it still doesn't really justify their $1.1 trillion valuation. So I think you could make a case for Tesla at about $300 or $400 a share in terms of buying it, and that would really fit some of what we do. It wouldn't be a large position for us, but we could entertain it. But at $1,000, I just don't think that they have the earnings leverage in their business model to actually generate that. So that's our view on Tesla, and that's why we don't own it. Having said that, we continue to revise everything that we do. We pitch every one of our core holdings, and I wouldn't be surprised to actually come out with a Tesla pitch within the next 3 months, and we might share that with clients. Probably not on the blog, but probably with clients, certainly, if you're interested.
Awesome. Thanks, Ben. Last story for today, United Health is buying LHC Group. It's a pretty sizable home health provider. Provides lower cost lower cost care at the home. It's kind of an alternative option for those staying away from kind of nursing homes, long-term care facilities, things like that. They do a lot of work with Medicare specifically. Ben, this seems like a pretty savvy acquisition from United Health, obviously a dominant player in the healthcare space, looking to expand and remain competitive in every way they can. How would you kind of grade out this deal?
Yeah, I think this is a really good deal from United Health. This is what they do. This is why they've become the largest insurance company in the United States on the health insurance side. I think it's a good deal. Basically, what this does is allows them to provide healthcare in the home through their Optum unit. Optum is a division of United Health that also manages pharmacy prescriptions and has some actual even physician practices. What I would say on this deal is I think it's particularly astute because the shares were trading of LHC above $200 a share last summer. This deal is only going to be an 8.1% premium to yesterday's close. It's going to be at $170 a share, so less than it was trading at last summer. And it does allow you to expand your footprint. I think that United Health could see some real synergies as they bring those costs down. LHC has pretty bad margins. Their margin profile is in the high single digit range. So this isn't a great business in and of itself, but as part of United Health, it could really be a strong business, and United Health's getting it at a pretty good valuation. LHC is based in Lafayette, Louisiana, has about 500,000 patients and operates in 37 states. I think it's well timed. I think that UNH is operating exactly as you'd want them to do as a shareholder. And I think this is a good deal for them.
Good deal. We are going to wrap it up there. Futures up quite nicely. Dow futures up 80 basis points. S&P futures up about 85. NASDAQ futures up close to 1.1%. So things looking green. Obviously, I think things to keep an eye on is any headlines that show a divergence in expectation relative to peace negotiations. We'll continue to look at people potentially tightening allocations and seeing what kind of impacts those have on the market. And we'll keep monitoring that through the end of the quarter. Quarter wraps up on Thursday, so kind of a final push to see where we end up for the quarter. Hope you guys have a great day, and we'll talk to you soon.